General Motors, once a dominant force in China, has hit a wall. In late 2024, GM announced it would take a $5 billion hit on its China operations, a stunning reversal in what was once its most promising market. The move signals a crisis for GM, whose fortunes in China have been battered by trade wars, tariffs, and fierce local competition. Once, China was GM's crown jewel, with Buick enjoying prestige and sales outpacing the US. But the market evolved rapidly, especially with the government's push for electric vehicles. GM's old strengths became liabilities. Tariffs raised costs, supply chains faltered, and nimble Chinese rivals surged ahead. The $5 billion charge is more than an accounting loss. It's a public admission that GM's China strategy is broken. The value of GM's Chinese assets has plummeted, and consumer demand has shifted decisively to local brands. For GM's leadership, this is a wake-up call. The playbook that worked for 2 decades is now obsolete. The company faces a stark choice: reinvent itself for a new era or risk fading into irrelevance in the world's largest auto market. The road ahead demands a complete overhaul of GM's identity and ambition in China. GM's $5 billion charge is split in two: a massive write-down and a costly restructuring. The first, a $2.60 $2.9 billion impairment, reflects the collapse in value of GM's Chinese joint ventures, an admission that future profits will be far lower than hoped. The second, a $2.7 billion restructuring charge, is real cash to close factories, pay severance, and shrink GM's footprint. Plants that once buzzed with activity are now shuttered, as GM retreats from overcapacity and falling sales. The impairment is a reckoning with lost market share. The restructuring is a painful bet on survival. Together, they tell the story of a foreign automaker outmaneuvered in its most important international market. CEO Mary Barra's team is moving urgently, taking the hit in 1 quarter to reset expectations and chart a new, smaller course. For GM, this is both a confession of past mistakes and a desperate attempt to salvage the future. GM's fall in China has been swift and brutal. In 2023, its China operations still delivered $353 million in profit. By 2024, that swung to a $347 million loss, a $700 million reversal. Sales have collapsed. GM's main joint venture with SAIC once sold 2 million vehicles a year. In 2024, sales plunged nearly 60%, with fewer than 400,000 units sold. Showrooms that once bustled now sit empty, as Chinese consumers turn away from GM's offerings. Quarterly deliveries have dropped relentlessly, highlighting a brand in freefall. The problem isn't a temporary dip, it's a sustained disconnect between GM's products and what Chinese buyers want, especially in electric and tech-forward vehicles. With massive fixed costs and plummeting sales, profits have been wiped out. Each unsold car deepens the financial hole, forcing GM to act. The China division, once a crown jewel, is now a liability demanding drastic intervention. GM's decline is driven by the rise of China's homegrown automakers. Companies like BYD have leapfrogged foreign rivals thanks to government support and rapid advances in technology and design. In 2024, BYD sold over 10 times as many vehicles as GM's joint venture, a staggering market conquest. Chinese brands have mastered local tastes, offering advanced tech, connectivity, and affordable electric vehicles. While GM clung to legacy models, domestic players flooded the market with EVs that captured the zeitgeist. The entire landscape has shifted. Foreign giants are now underdogs, squeezed by price wars and superior local products. GM's cost structure can't compete with lean, government-backed Chinese firms. The result? GM is forced to discount heavily or watch its sales evaporate. Once a heavyweight, GM now finds itself outmaneuvered by faster, more agile local champions. GM is responding with a sweeping overhaul of its China business. The company is closing underused factories, consolidating production, and slashing fixed costs to survive on a smaller scale. The restructuring is expensive now, but essential for long-term viability. GM is also revamping its product lineup, accelerating the shift to electric vehicles and in-car tech to better match Chinese consumer demands. Unprofitable models are being cut, and investment is shifting to EVs that can compete with BYD and NIO. This requires a cultural shift, designing for China first, not Detroit. GM's new goal, a profitable, smaller operation focused on niche and premium segments, not market dominance. The company is determined to build a business that stands on its own, even if it means accepting a permanently reduced role in China. GM's new China strategy is about survival, not supremacy. The focus is on self-sufficiency and modest profit, not chasing volume. The company hopes to return to profitability in China by 2025, but analysts remain skeptical. Like other Western automakers, GM is pivoting to premium segments, betting that Cadillac and Buick can still attract buyers seeking quality and heritage. Despite the China setback, GM's global outlook remains strong, with North America driving profits. Investors seem relieved by decisive action, but the road ahead is uncertain. Success depends on flawless execution, compelling new EVs, and navigating a tough joint venture landscape. GM's $5 billion loss is a cautionary tale. In today's auto industry, adaptation is everything and past glory offers no guarantees.